The single US index fund you might already own quietly owns the biggest companies on the planet. Those companies make most of their money outside America. Every advisor tells you to bolt on a separate international fund to feel properly diversified. Here's what they skip. You already are. You bought the whole world the day you bought the US market. You just never got the memo. I only understood this because of a guy named J.L. Collins and his stock series, plain English writing about index investing. By the end of this, you'll see why the Add International advice is solving a problem you don't actually have. The investing industry runs on one trick, and it's not complicated. Convince you your portfolio is missing a piece. New asset class, new fund, new thing to buy, so you feel like you finally covered your bases. International was the piece I went looking for. I'm at my laptop, brokerage tab open, and I've got a chunk of cash sitting there, ready to move into an international index fund. Because that's what a proper portfolio has, right? I'd been scrolling through some allocation models somebody posted online. One of those pie charts with a dozen neat little slices. And there it is, a whole wedge labeled international. Mine doesn't have that wedge, and I'm sitting there thinking, everyone's chart has this piece. Mine's missing it. I must be doing this wrong. So before I click buy, I do something I'll actually give myself credit for. I stop and check what I already own first. I pull up the holdings list for my US total market fund. Apple, Microsoft, Amazon. Then I just stop. Lean back in my chair, half laughing at myself, because I'm one click away from paying extra to feel sophisticated about something I already had. Apple, Microsoft, Amazon. Those aren't really American companies, not in any way that matters for your money. They're global empires that happen to have their headquarters here. That's genuinely the only thing American means in this context. A mailing address on a filing with the SEC. Nothing about where their factories sit, where their engineers work, or where their customers actually live. Think about the actual size of what you're holding for a second. A US total market fund like VTSAX holds roughly 3,600 companies. Virtually every publicly traded company in the country sitting in one fund for one price. And the giants at the top of that list are doing most of the heavy lifting for your returns. Many of them pull 40% or more of their sales and profits from outside the US. The near miss became the lesson, and it's a simple one once you actually see it. You can't add exposure you already have. You can only pay twice for it. Okay, they sell stuff overseas sounds a little vague as arguments go. Somebody in Tokyo buys a phone this afternoon. An office in Berlin renews its software license this morning. And somewhere in London tonight, a package shows up on a doorstep that nobody there thought twice about ordering. That's 3 cities, 3 currencies, 3 time zones, all feeding profit back to a company you already own a sliver of. Meanwhile, I still get irrationally annoyed when my own Wi-Fi buffers for 2 seconds. And my index fund is out there clearing customs on 3 continents without me lifting a finger. Your money is out there earning in currencies you've never even touched. It's working a shift in Tokyo right now while you're asleep. So the label US stock is really just a headquarters address. It's not a description of where the money actually comes from. It never was. You're not concentrated in one country. You're concentrated in the companies the entire world buys from. They just happen to file their paperwork here, tax law and history, not where their customers actually live. And here's the part that makes this structural, not just a handful of cherry-picked examples. The S&P 500 makes up roughly 75% of a US total market fund. 3 out of every $4 you've invested is sitting in exactly these giant, globally earning companies. That's not a side exposure, that's the bulk of the fund. Nobody sits you down and tells you that US index fund already means global business exposure. No advisor opens the fund and shows you the holdings list. You'd have to open the fund's fact sheet, the document that lists where each holding is headquartered, and find the country breakdown yourself. Almost nobody does. So you assume you're missing something because no one ever showed you what was already inside. The fear everybody walks around with is, I'm too concentrated in one country. I had that fear. It's a reasonable thing to worry about, until you realize the twist. The country label is basically cosmetic. The earnings underneath it were already global the entire time. Even the smaller names further down the list, the ones that never make headlines, sell into markets you've never set foot in. A few thousand companies with customers on every continent, wearing one country's return address. If you already own the world then, what exactly are you paying for when you bolt on a separate international fund on top of it? Turns out, that's not a hypothetical question. It's a direct cost, and it's the cost of duplicating exposure you already have. Adding a dedicated international fund on top of what you already have isn't free diversification. It stacks real downsides onto exposure you were already carrying. Start with currency, because it's the one people underestimate the most. Foreign companies trade in their home currency. That currency swings against the dollar constantly for reasons that have nothing to do with how the company itself is actually performing. Say a European fund returns 8% in local stock terms for the year. Solid year, nothing dramatic. But the euro slides 5% against the dollar over that same stretch. Convert the return back into dollars and you're sitting closer to 3%. Same companies, same year. A worse number, purely because of which side of the exchange rate you happened to land on. Whew, that's a whole extra layer of did I actually make money, or did the exchange rate just move under me while I wasn't looking? Your US fund sidesteps that entirely. You're already being paid in the currency you spend. A US total market fund like VTSAX runs around a 0.04% expense ratio. Even Vanguard's own cheap international index fund runs more than double that. I will absolutely price compare gas stations to save 4 cents a gallon, and somehow paid this fee for years without once opening the fact sheet. It's not a massive number sitting by itself on a page, but you pay it every single year, forever. There's no notification that pops up telling you what that gap actually cost you. It just quietly eats a little more of your return every single year for as long as you hold the fund. I think about this the same way I think about conscious spending. Spend fully on what actually matters to you. Cut hard on what doesn't. That's my actual position on money, not just a line I use in videos. I'm not telling you to cut every subscription you have. That's not the point of this channel and never has been. But I am telling you not to pay a recurring premium for something you already own. That's not discipline. That's just not checking your own portfolio closely enough. And honestly, it's the same complexity theater I keep running into everywhere else in this space. More funds, more asset classes, more moving parts. All of it sold to you as sophistication, as if owning more things automatically means you're doing it better. Here, simpler wins outright. It's cheaper, it's lower risk. That combination almost never happens in investing. When it does, notice it. Here's the fix, and it's not complicated. The exposure you were trying to buy by adding international is already sitting in the fund you own. You don't add a second fund to get it. You just stop paying twice for what your total market fund already earns you. None of this makes international always the wrong call, though. I'm not going to tell you never buy international. Full stop, end of discussion. That's guru energy. The kind of overconfident, one-size-fits-all pronouncement I've been pushing back against this entire channel. Nobody who tells you there's exactly one right answer for every single person is being straight with you. Here's exactly who it's for. Say you've actually looked at the data and you genuinely believe global markets are going to outrun the US over the next few decades. If you want to make that bet on purpose, with your eyes open, that's a legitimate call. It's yours to make. In practice, that usually means tilting the stock side, maybe 10 to 20% toward international. not replacing the US fund, just adding a slightly bigger slice of non-US companies than your total market fund naturally holds on its own. One extra line on the statement, checked once a year. Nothing complicated. Same logic applies if you're investing from outside the US. Owning only your home country's market really is a concentration risk then. Someone in Germany holding nothing but a German total market fund has the exact same problem the industry keeps telling you that you have, just for real this time. Same idea as someone here owning nothing but US stocks with zero other exposure. For people in either situation, a small international slice is reasonable, and there are simple ways to do it without overcomplicating things. Collins points to something like a total world fund, VTWAX is one example, sitting around a 0.10% expense ratio. Basically, everything in one fund, one ticket. I recognize this instinct. It's the same one that kept me out of the market for years before I ever started, just aimed at a different decision. Back then, it was thinking I had to pick the right individual stocks, and that felt too much like gambling to risk. Now it shows up as wanting the perfectly optimized portfolio. Same fear, new outfit. The fix is the same too. Simple, held on purpose, beats optimal, you never actually buy. But there's a real distinction here. That's a preference. It is not a requirement. The default, a plain US total market fund, sitting there quietly doing its job, already gives you global earnings exposure for less money and less risk than the alternative. Adding international on top of that is a choice you make on purpose, with full information. It's not a hole you're patching because you think you did something wrong. It never was. So the problem the industry sold you never actually existed in the first place. You already own the world through one fund for a fraction of the cost of owning it twice. And that's only the stock side of your portfolio, which raises the real question: what's sitting in the other half you haven't touched yet? Everything we just covered has been about the stock side, the growth engine of your portfolio, the part doing the heavy lifting. But there's a second piece almost every portfolio pairs with it, and it has the exact opposite reputation. Bonds are supposed to be the safe part. That's the whole pitch. Stocks for growth, bonds for safety. But safe is doing a lot of work in that one sentence. Bonds carry their own default risk, their own interest rate risk, their own inflation risk. That combination trips up almost every new investor who assumes bonds just means boring and done. There's a way one broad bond index fund quietly cancels out nearly every one of those risks at once, just by how it's built. And understanding why is the difference between bonds actually protecting you and bonds quietly dragging your returns down without you ever noticing it happening. It's the other half of the portfolio, and it's honestly not as boring as it sounds. One fund, 3 risks, canceled out almost by accident. Click the video right there. I'll show you how that actually happens.